Hey, what's going on? Hope you're having an absolutely amazing day. Thanks for joining us for our options trade case study. And really, what the purpose of this session is to show you one options trade and really how it was set up and identified and what does it mean and really kind of break it down. I know that some of you out there have some options experience and some trading experience, and some of this is going to sound like fundamental knowledge that everybody should know. And some of you are brand new and you've never looked into to trading the options markets or the financial markets in general, and that's okay. This is really designed for you to see what's out there, what's available, and give you a little bit of guidance and support. Don't think that you're going to learn everything you need in here. This is really just to kind of open your eyes. Now, there are some things hopefully you'll pick up out of this. I'm going to make this as educational as possible all the way through. So, what I'm going to show you is a trade on a very common stock that everybody seems to know. It's Apple, right? Get your iPhones ready because we're gonna talk about it. You may be watching this on a Mac, or you're watching this on your iPad or your iPhone, but we were trading Apple stock, and this is in a live trade room. So what I'm going to do is I'm going to play a short clip of us looking at this in one of our Sunday evening live trade rooms. Now, one of the things that we do is every Sunday night we take a look at the markets coming forward, and we were looking at the options setups for the coming week. We do a lot of those Sunday nights. We do some of them Mondays early in the day so that we can get ready for the week. The idea being is that we set up our week before the week begins so that we don't make emotional decisions. Emotions can be the enemy of a trader. And we want to make non-emotional decisions when the markets aren't moving or when they're closed, and so that we can plan the trade effectively. And so I'm going to show you this video. This is from a live trade room, but I'm going to narrate it, and I'm going to come in and out between the live trade rooms. So here you go. This is the Apple trade back on June the 13th. You know, when I first was looking at it, I really was looking at selling the 120 puts. Because, I mean, the 120 puts, we haven't been below 120 in Apple in a really, really, really long time. And so I thought that I would start with the 120 puts. And if we sell the 120 puts, what kind of credit are we getting? Well, the downside is that if I throw my implied volatility on here, we're getting two things, Jack and Squat. And Jack just left town because there's the implied volatility is at its lowest point of the year. So what are we talking about there? We're talking about selling puts. Now, what does selling puts mean? Well, there are two types of options, calls and puts. And essentially, these options are insurance policies. The way we think of options is think of them as insurance policies. A put is insurance against stock that somebody buys, because when you buy a put, you have the right to sell a stock at a set price on or before a set date. That's the definition of a put option. It's a contract that gives you the right to sell a stock at a set price on or before a set date. So if you buy a put option, you have the right to sell stock. Well, whoever I buy that option from is obligated to buy stock, right? A put option is essentially like a car insurance policy, right? With car insurance, you pay a premium, and if your car gets totaled, the insurance company then has to buy your car. Well, think about it from the form of stock. Is that if I sell a put to somebody else, I'm now obligated to buy the stock if the stock crashes, meaning it goes down. And in this example, I was thinking about selling a put because I wanted to buy the stock. Now think about it. Why would I want to buy the stock? We would want to buy the stock if we think the stock is going to rise in value, right? You want to buy the stock when it's on sale. So a lot of people don't realize you can get paid to be a willing owner of stock. That's right. You can be paid as long as you're willing to buy stock. I can get paid for that. And so that's what we were looking for in this one. The problem is that I wasn't getting paid enough. I have to be paid enough to be commensurate with the risk that I'd be taking. And in this case, I wasn't getting enough money to be paid to sell that put. So it didn't make any sense for me to sell the put. So I now have to find a different strategy. See, what's great about this is with options, and we call it 3D options, 3 directions, up, down, or sideways. I want to be able to get paid no matter which way the market goes. And so I just need to change my strategy based upon what is the option going to pay me, or what is that option going to cost me. So in this case, what's called my implied volatility, which is essentially my pricing gauge. The higher the implied volatility, the higher the pricing. The lower the implied volatility, the lower the pricing. And in this case, our implied volatility was low. So that tells me I probably don't want to be selling options. I'd much rather be buying them. So let's take a look at really what's the technical setup in this trade. What I'm looking at on this one is just not overthinking it. Just buy the call. Just buying a call on a breakout above this region in here. And I tried to take a look and see about the BFF. Does it make sense to sell puts in order to pay for the call premium? In reality, it doesn't, because I want to do that when my volatility is higher. And so you could sell a put in order to decrease your call cost, but the puts just being as cheap as they are doesn't make any sense. So when I'm looking at this, what I'm thinking here is you've got to stop at about 123.17. So let's put this here. Put this in red. So stop just below here. Actually, got to go a little lower. All right, stop at 123.10, which gets us below this day's low. Entry is right here. And then your first target, so here's our risk. One to one, 2 to 1. Do we think that there's enough room there to get us to 138? Well, we have a little bit of a supply area up above us, right? But what do we think about the quality of this area of supply? I don't think it's all that great. Matter of fact, I think it's more of a resistance line up here. And so I think you've got a 2 to 1 reward to risk area right over here. Okay. So that would be target 1, and then target 2 would be this area right up in here. All right, so let's draw this one out. So there's our setup. We now have a trade that's a breakout trade, and breakout trades follow very specific rules. Our rules for breakout trades are very well documented in that we need minimum touches, we need room to roam, we need basing right before the level, and so this qualifies for our breakout trades. And then we've already identified our entry, our stop, and 2 potential price targets. So now, if I know my entry and my stop, well, those 2 things together give me the risk, right? Risk is the difference between entry and stop loss. The definition of reward is the difference between entry and target. And so if I know my entry, my stop loss, and my target, I can then very easily calculate my risk to reward. So then the question becomes is how do I trade this? How do I trade it? Well, the easiest thing to do is just to buy the stock, right? I could just buy the stock. I know my risk. I know my reward. My reward is twice the amount of my risk in this case. So with a risk amount that we already know about, and that risk amount is $5.23 a share, then our reward is $10.46 a share. Now, why is it important that we know our risk and reward going in? Well, because when we think of a trade like this, there are 4 outcomes that can occur. Let's talk about those 4 outcomes. Outcome number 1 is that we never get filled on the trade, right? We never get filled. Price actually doesn't hit my breakout point, and I don't get filled on the position. Now, why would that happen? Well, that's because I've got a breakout trade set up. Price may never break above that level, and it may fall away. We use what are called day orders in order to execute those trades, and if that trade doesn't get filled, then there's no risk at all, right? Outcome number 2 is that we get filled on the trade and it hits our stop loss. So if we get filled on the trade and it hits our stop loss, we have to know how much we're going to lose. We know what we're going to risk going into the position. And so going into the position, I know that I'm risking $5.23 per share if I was trading the stock. Now, certainly we're also going to look at trading the option on a position like this. But I know my risk going in. Outcome number 3 is that we may get into the trade and it does not hit our target. or our stop loss. So in this case, we're going to utilize what's called the 6-candle rule. So we have a 6-candle rule that we find is a very helpful rule for traders and investors. If price hasn't started making its move within 6 candles, we want to close that trade out, or at the very least, take our stop and adjust it to our break-even point. What this does is this minimizes our exposure in the position, and it means that I'm not gonna just have my capital in a useless trade. I want to go and deploy my capital to something that's going to move a bit better. Now, outcome number 4 is that it hits our price target or multiple targets in this instance. And so in that case, we're going to get at least a 2-to-1 reward to risk. So there are multiple outcomes that can occur, but let's look at, just the stop loss and the target being hit. If I've got a 2-to-1 reward to risk, what happens if I've got a 50-50 winning percentage, right? Think about it. I've got a 50-50 winning percentage. When I'm wrong, I lose 100. When I'm right, I make 200. Well, if I take 5 wrong trades times $100, I've lost $500. If I take 5 right trades times 200, I've made 1,000. So if I have a 50-50 winning percentage, but I got a 2-to-1 reward to risk, I'm still going to be net profitable. What if I've got a 40% winning percentage with a 2-to-1 reward to risk? Using the same math. If with a 40% winning percentage, let's say I take 10 trades and I'm risking $100. So I lose on 6 trades. I lose a total of $600. I'm right, I win on 4 trades, and each trade makes me 200. Well, now I've made 800 against a loss of 600. I'm still profitable. See, I think a good number to shoot for is to be right 40% of the time. Now, by the way, you're going to find traders out there that say, hey, I'm right 80, 90% of the time, and more power to you. But in reality, with a 40% winning percentage, 50% winning percentage, heck, if you can get it up to 60%, you can have significant levels of success in the financial markets so long as you've got a plan about controlling the risk and really maximizing that reward. So now we're going to switch gears a little bit, and we know the setup of the trade, the entry, the stop, and the target. But one of the things that I always say is that every good options trade first starts out as a good stock trade. Every good options trade first starts as a good stock trade. So now let's go look at the option setup for this position. So if I look at this one, I have going out to the August calls. And when I go out to the August calls, the 130s are giving me a delta of 0.44, which is typically going to be my high point of gamma. And so when I look at this, let's see, this is a 68-day option. So I'm going to go out 68-day. Yeah, so let's go out 34 days. And let's look at our numbers. 123.10, 128.33. What was our other one? 137.78. All right. So looking at this at target 1, we're not even looking at target 2, but at target 1, we're looking at a profit of about 609. Now, that's 609 minus the $41. Remember, because this is a breakout trade. So we'd have to add that $41 to my P&L on the loss. So my risk is about $200 on this position. And then I'd have to take it away from what this would be. So I'm roughly at about risking 200 to make 550. Does that qualify for a 2-to-1? Sure, it does. I think that's actually a pretty good little trade with a fairly good degree of probability. I think that Apple getting to 137 can happen in a few days. It's not a really big one, especially if we see the NASDAQ break to a new all-time high, right? NASDAQ breaks to a new all-time high. I think that then you have a really good shot of Apple continuing to go higher. So this gives me a Now that's as of today, right? So on halfway through, I've got a profit of about 488 against a risk of about 283. So it's certainly we want to make this move as quick as possible. And I would say if it gets halfway, it might make sense to kind of move that stop. But let's look at it from a bull call spread perspective and see what the bull call spread gives us. So instead of doing the long call, let's do the 125 by 135. Gives us a delta of 28. So it's a $10 spread. We got a 422 debit. And our risk graph on this looks like in this case, because we're beyond the theta switch point, the time actually helps us. So you're looking at making about 350 against a loss, if it goes against you, of about 177. So whether you do the 125 by 135 bull call spread or the 130 long call. Now, what's the advantage to the 130 long call over the 125, 135 bull call spread? What's the advantage? Yeah. The advantage is the unlimited profit that you're given. Okay? Unlimited. So if it goes to 150 in that period, which by the way, is it possible that it makes it to 150? Yeah, it is, but I don't really see that happening in the next month. I don't see Apple getting to 150. We don't typically see that big of a movement in Apple in a month. So I think that it's really the call actually is going to tie up a little bit less capital than the bull call spread. In this case, the bull call spread is going to tie up a little bit more than the call. Now, with the bull call spread, you don't have as much theta decay. You will have some theta decay, but it won't be as bad as the long call. So, frankly, in this one, it doesn't matter to me which one you do. My personal opinion is I would just do the long call. All right, questions on that one? I think that one's fairly clean. Next, Costco. Ooh. So we got into a little bit deeper of an options discussion there. And if you're not familiar with some of those terms, delta, gamma, theta, bull call spread, don't worry so much about that at this point. What I want you to grasp out of there is that we don't expect you to know everything in the live trade rooms. We want to hold your hand and really guide you through how to set these trades up. And we gave you two different options, two different trades to take from one position. What's actually interesting about there, if you think about it, we really gave you three. There was the stock trade, there was the buying of the call, the long call position, or there was what's called the bull call spread. Each one has its own uses and merits, and each one has its own risks. And so, as an investor, as a trader, you want to be able to weigh the risks and the reward of each one. Now, in this instance, I think that the just the long call, which means buying a call, made the most sense. And so, when I look at it from a long call perspective, we can go back and take a look at what did the results of this trade mean. But more importantly, it's not about the results. And this is what I say all the time. The results we cannot control. But what we can control is the process. The process we use in order to find high probability turning points, high probability breakouts, and then how do we take those opportunities and convert them to options, futures, different asset classes in order to achieve what our financial goals are. 3, 2, 1. So let's go ahead and take a look at the result. Now, what's kind of good about this particular platform is that I can see very easily what my trade did by going back to what's called an on-demand feature. So in this case, that option on that day, if we were taking a look at it, it broke above the breakout point the very next day. And so on that day that we broke above the breakout point, our 130 call, you can buy it for $4.90 a share. So the $4.90 a share is the amount that you buy it for on that particular day. Now, let's move forward in time with this platform, and let's move ahead by a week. Remember, this was a position that we looked at for about 34 days, and let's see what that looked like. Let's just go to the end of the week. So by the end of that week, moving it from June 14th to June 18th, we see that prices have started to move, and so our 130 call, when we look at it, is trading now for $6.15 a share. So it went from $4.90 a share to $6.15 a share in a week. Now, that's a pretty good move up and a pretty good gain in value, but the stock has not yet hit our target. Remember, our first target was at about 136.87, somewhere in there. So we've not yet hit our target, but we are starting to move our direction. Well, let's move the needle by another week. And we move the needle by yet another week, we can see that we've still not yet hit our target. We're getting closer. We're at 135.24. Now, at that day, by the time we got to that level, our 130 call had moved up to 715. And so we can see that our value continues to move up. We are losing a little bit of what's called time decay each week, but we're gaining more than we're losing. Okay, now let's move ahead to July 2nd. Look at this. We've now hit target 1. So we've now hit our target 1. And on July 2nd, when we hit target 1, our option is now trading for $10.30. So that means that the option that we bought for $4.90 is now trading for $10.30. That's over 100% rate of return on that particular position. We've not yet hit target 2, so let's go ahead and look another week out and see where we are after another week. And a week later, we have now hit target 2. And so target 2, by the time we reach that position, we've hit our secondary target, and our option, which we bought for $4.90, we can now sell for $15.60 at target 2. That is a great return on this position. However, we knew before we ever got into the trade what we were risking in that particular position. And that's really what makes this a much more valuable setup and a much more valuable trade, is knowing what we're risking. And it was really just a very simple breakout trade above this area here, allowing price to continue to run. So hopefully this kind of opens your eyes to some of the opportunities that are out there and the opportunities that are available when you understand proper risk management. It's not about, transforming your life today. It's about living life on your terms. And the best way to live life on your terms is to be able to understand the risk that every trade provides, as well as how do I maximize my potential opportunity for profit. So I hope you guys had a great session here today. I look forward to working with you. Make sure that you reach out to my team so that my team can work with you and help you to kind of figure out what is your plan to live life on your terms.